In order to answer some of the questions that are coming up in Chapter 13 regarding accounting for current liabilities, we need to remember what we learned in Financial Accounting 1 related to the accounting for inventory. So we're going to do a quick recap of that here just to set us up for success in the questions that we're answering in Chapter 13. So the definition of inventory are assets that are either held for sale in the ordinary course of business, or they're in the process of production, or they're in the process of supplies or materials to be consumed in the production process. So as long as one of these criteria is met, the inventory will be classified as a current asset on our statement of financial position. Inventory is recorded at one of 2 points, and that really depends when the title passes. So the title can pass when the goods are shipped, which is FOB shipping, or the title can pass when the goods are received, which is FOB destination. Purchase discounts. So suppliers often offer cash discounts for prompt payment. So you'll see terms like 2, 10, net 30. What this means is that if you pay within 10 days, you get 2% off. If not, the balance is due in 30 days. Inventory needs to be recorded at cost net of the discount, even if the discount is not taken. So ideally, the loss discount is considered a cost of financing and is debited to an expense account called loss purchase discounts. And there can be the gross method or the net method of accounting for purchase discount. So that's the gross method where you're showing the purchase discount separately on your income statement, or it can just always be recorded net. There's 2 types of inventory accounting. There is a perpetual system and a periodic system. A perpetual system continually tracks changes in the inventory account itself. So purchases of materials or sales are debited to inventory. So it's pretty simple. Everything just goes straight through inventory, and your inventory account is always expected to be current or at the proper balance at your statement of financial position date. Freight in is also debited, or purchase returns and allowances all go through inventory, same thing. The cost of items sold is recognized at the time of sale by debiting cost of goods sold and crediting inventory. So obviously cost of goods sold is on the income statement, and then inventory is on the statement of financial position side. And inventory is really a control account, meaning that it's always expected to be correct, and then it's verified through a physical count. So in a perpetual system, you would always be hitting the inventory account whenever there's a change going through your balance sheet or statement of financial position. That's quite different than the periodic system. So the periodic system, you're only determining the quantity of inventory that you have on hand and periodically via account. So your inventory account on your statement of financial position is not up to date. So you're using different accounts to track the different components that are related to inventory changes. So for instance, each acquisition of inventory, so each time you purchase materials or you're adding to your inventory if you're purchasing finished goods, then you're debiting them to a purchases account. Returns and allowances are credited to a purchases and returns account. And cost of goods sold is only recorded at the end of the period. So it's not recorded when the goods are sold. And the cost of goods sold is calculated as the beginning inventory plus purchases less your ending inventory gives you your cost of goods sold. And you determine the ending inventory through a periodic count. So essentially between the 2 methods, if you think about the journal entries, in the perpetual system, at each time something happens to your inventory account, so you purchase raw materials, you have a purchase return, you have freight, you're always hitting that inventory account. With the periodic system, you don't touch the inventory account. Whenever there's a change in the period, you're either hitting a purchases account, a returns and allowances account, a freight in account, etc. So here's an example of accounting for inventory. So Global Limited had beginning inventory of 50 units that cost $100 each. During September, the company purchased 200 units on account at $100 each, returned 6 units for credit, and sold 150 units at $200 each. So we've got a beginning inventory, we've got purchases, we've got a return, and we've got the sale of goods. And so we're asked to journalize the September transactions and contrast a perpetual system from a periodic system. So A is asking us to record the journal entries using a perpetual system, and B is asking us to record the same transactions using a periodic system. So let's see how the accounting for these types of transactions would be different based on the two different methods of accounting for inventory. So here you can see that with a perpetual system, when we have the 20,000 is 50 units that cost $100 each. So that's the beginning inventory. It's 50 times 100. Let's see what we've got here. Okay, so we've got beginning inventory of 5,000. So we don't need to journalize the beginning inventory. Then we've got during September, the company purchased 200 units on account at $100 each. So this is the first journal entry that we need to make. So it's a purchases journal entry. And so what you're going to see here is that in a perpetual system, we're going to debit inventory directly for the amount of the purchase, which was $20,000. And we're going to credit accounts payable. And I believe it said it was on account. Yeah, on account. So that's how we know it's accounts payable and not cash. In a periodic system, we don't hit the inventory account directly. We never touch it. So we're going to debit our purchases account for 20,000, and you can see the credit continues to be accounts payable. So the only difference between these two entries is where the debit goes, whether we're touching inventory, which we do in a perpetual system, or what we do in a periodic system is we hit a specific account labeled for that, like purchases. Next, there's a return. So they're going to return 6 units for credit. So it's 6 units of $100 each. So you can see that in a perpetual system, we're going to have the debit is to accounts payable, and both actually, the perpetual and the periodic, because now we are getting a credit back. So this is actually the company that we're returning it to owes us the credit. But you can which is the debit journal entry, a little bit confusing there. But the credit or the decrease to the assets on our statement of financial position. For a perpetual system, we're hitting inventory directly. And in a periodic system where we don't touch inventory, we're crediting the purchases return account. You can see, of course, that the journal entries are for the same dollar amounts. It's simply where the debit or the credit goes if it touches inventory or not. Oops. And next we've got, and then they sold 150 units at $200 each. So the sale of the units, so both of the debits are going to be to accounts receivable. And then the credit is going to be the sales revenue for both. So that's the same transaction. There's no impact to inventory for the actual sale, but what there is an impact for is the cost of goods sold. So we are going to recognize the cost of goods sold immediately in the perpetual system. And the cost of goods sold, it says that there are 50 units at $100 each, 6 units. So we returned 6 units, $150 units, sorry. So the cost of those units is $100. So 150 units is going to give us $15,000. So we're going to go debit cost of goods sold and then credit inventory. You can see we're directly decreasing the inventory in our balance sheet when we are recognizing that cost of goods sold under the perpetual system. The periodic system, we don't recognize cost of goods sold. We won't recognize it until there is the periodic inventory count, and then we will calculate our beginning inventory plus our purchases, less our ending inventory is going to give us our cost of goods sold. We don't have the information to do that in this question. There isn't an ending inventory balance given, so therefore we don't recognize cost of goods sold in these journal entries. And that concludes our recap on accounting for inventory. Hopefully that's helpful. Let's get back to chapter 13.